Hello everyone and welcome back to the channel. My name is Brent and in today's video we're going to be doing a recap of the M1 Finance portfolio. I've been having a few comments across different videos and in the community tab as far as how has the portfolio has been going. Have I sold out of the market? Have I been buying into the market? So in this video, we're going to go ahead and do a quick recap of the last month. We're going to take a look at the M1 Finance portfolio. I did sell back in December of 2021. I did also buy in January of 2022. Whatever I had sold out of back in December, I went ahead and redistributed that money here in January. So we're going to go ahead and go over what stocks I sold in the past. We'll go over the performance since I had sold them. We're going to go ahead and cover the companies that I did purchase with the equity that I had received from those companies. And then we're going to go ahead and cover all the positions in the portfolio. These are all dividend companies. And take a look at where they're currently trading at, their 200-day, 50-day moving averages. And I'm going to go ahead and decide what companies I want to start buying here in this current market. I constantly want to buy. I haven't added any new money into the M1 Finance account or just any of my accounts. I don't think I've added any new equity in besides my work Roth 401k. So we're going to go ahead and take a look at it today. If you guys have any comments or questions for me, if you guys are watching this, let me know that down in the comment section below. Any specific questions, any specific video, details and such you want to see in the future. I know I told myself I wanted to create more content here in 2022, but I've been kind of slacking off on the channel here. So I want to go ahead and kick it off here in February with the first video of the year, right? So yeah, if you guys are brand new here, definitely go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time we release a brand new video, and of course, give this video a thumbs up, and let's go ahead and get into the video. So really quickly, here we are, the market closed on, that's not the button, the 1st of February 2022. The market today skyrocketed, right? Here we are on Tuesday. Monday it was up 1.89%, Friday up 2.43%, Tuesday 0.69%. The market year to date had dipped by almost 10%. We were in a correction territory, and here we are over the past 3 days alone, making up nearly 4-5% of what we had lost here within the last month. So just crazy recovery here within the last few days. I don't know if this is where the market's going to be in its recovery phase. I don't see any reason for the market to be recovering this early, especially when the Fed has announced that they're going to be raising rates here in March. They don't know, nobody knows if it's going to be a 0.25% increase or a 0.5% increase. I've seen people discuss rates of increasing, 3 to 7 times here in 2022, and that all could play a part in the market as far as the performance. So I'm really in the wind here as far as what's to be expected, but this could create some really awesome buying opportunities here in 2022 because we're not just investing for today, this week, this month, this year, right? We are looking for opportunities to invest for the long term, and if the market falls here in the short term, that is the best opportunity for it to recover over time because today's economics, today's politics doesn't matter in the next 10, 15, 30 years. It won't matter. Price will just continue to gradually increase with the, rate of inflation and such. So yeah, S&P 500 has recovered quite nicely, being down 10% at the very end of January. And then here towards the last few days has recovered really nicely. The Dow Jones up again, same thing. 1.65% on Friday, 1.17 on Monday, 0.78 there on Tuesday. And then we had the NASDAQ recovering 3.13% on Friday, another 3.41% on Monday, and a 0.75% there on Tuesday. So I know the NASDAQ had been hammered the worst out of the indexes, but it has also recovered the most within the last week. So here we are. If we look at the 1 month, you'll see that positions are down overall. The FANG stocks got hammered besides Apple, only down 1.67% over the last month. We still see Microsoft is down 8.2%, Google is down 4.98%, Amazon is down 9.31%, Tesla down nearly 12%, and so on. The only companies that really did well in this time frame were, banks and financials with rising rates. We're going to see that financials, we're going to see insurance, we're going to see utilities start to kind of creep up potentially, right? Energy not really within that threshold of getting benefits from rising rates, but banks, if they can loan out money at a higher rate, that's going to be beneficial for the banks. If insurance can issue out insurance at a higher premium, that's going to be better for them. And utilities will always creep up, say 5% per year, just over time. And if inflation is going to be any higher, they probably may hike prices a little bit higher. I think here in Oregon, I looked up the utility increases. It is expected to increase by like 5.2% here in 2022. So yeah, those three sectors do fairly well in rising rate environment. So, but as of close here on Tuesday, this is where I want to jump into really quickly. One of the main things I was watching today was Google. Alphabet. Here after hours, they announced their earnings. Based off their earnings and like crazy momentum, plus they're doing a stock split here. They're doing a 20-for-1 stock split. So if their price here closes at say $3,000 before they split, they'll split up 20-for-1. So that'll be $150 per one share for Google. So that's going to open it up to a lot more investors being able to invest in Google. Not all brokers allow fractional shares. So I know M1 Finance, Webull, Robinhood, Fidelity, those are the only 4 platforms that I know of that let you invest into fractional shares on the majority of ETFs and individual companies. A lot of the other brokers, my other broker, Merrill Edge, doesn't let me buy fractional shares. So I can now buy 100 shares of Alphabet at $150. That would cost me $15,000. But hey, that's a lot better than $2.7 million to own 100 shares of Google. So that allows investors to have more potential in buying Google. I think that'll just kind of bring more investors to Google and allow more option play for a company the size of Google right now here. So that was interesting. Yeah, Google is splitting 20-for-1. Could Amazon be next? Amazon in itself is, I think, like over $3,000 right now. Amazon stock here, $3,023. So they're pretty much in the same price range as Google. I would like to see a stock split on Amazon as well, but that hasn't been announced yet. The other company here I was watching in the after hours was PayPal. This one has been straight hammered here. We can see that PayPal is down, it's down over 50% off their highs. And just today alone, look at this, after hours, it is down nearly 18% in the after hours. So it is crazy. This is all because of their guidance. They guided a lot lower, and that, of course, bled them out super hard. I had been watching PayPal as a potential, buying opportunity in my other growth fund, my growth account, but I'm not seeing the potential here. I see potential, but I don't see it happening anytime soon. This company is just continuing to bleed out and hemorrhage money right now. So it's pretty crazy. So yeah, that's all the main news that I have been tracking as far as the markets go. The 2 companies that I watched on earnings today were Google and PayPal. Now, jumping over into the M1 Finance portfolio, let me go ahead and get logged in here. Okay, so now we're logged into the account, and here we are at the overall portfolio. We're looking at the overall performance. We can see here that recently, back in December, I did sell from a high of around 43,000, about nearly $6,000 of equity. Our portfolio dropped to about 38,000 for a bit. And then I was kind of reevaluating what positions in my portfolio do I want to re-put my equity back into. So we'll kind of cover some of those companies here in just a minute. I think our portfolio total return overall at a high has been about 78%. So really off of the highs here, we're still doing fairly good. I think we were down maybe $1,000 or so, some change. And we can see here that our market gain still remains about 8,860, and our earned dividends continue to increase day after day, week after week, month after month, year after year. Not too long ago, our earned dividends had hit 1,000, then it hit 2,000. Now we're nearly breaking $3,000 in earned dividends, and this is going to continue to compound and grow month after month, year after year into the future. If we look at the 1 month here, really quickly before we jump over to the 1 month, we can see that the top performers here are Apple, up 356%. I did add into Apple. There was a time when Apple was, say, like $1,000 or so, $1,400 position. I went ahead and doubled down on Apple, so it's now about $3,000 of value. That's my biggest holding within this portfolio. Lowe's there is in second place at 163% gain. Main Street Capital and Lowe's have been kind of battling back and forth. Main Street Capital has lost a bit of energy here during January, so it did topple down. It's now at 140%, but still really positive there. As far as the negatives, we have a single company in the negative right now, and that is Clorox, and is down not really 18.74%. It's more down, I believe, like 8 or 9%. So no biggie right there. I did also sell out of positions down here that are still in the account, but they don't have any equity invested in them. So I'm going to be removing them from the portfolio, and I can actually do that really quickly right now, just by kind of targeting the companies here, which would have been the Esso, the Walmart, Kimberly-Clark, 3M, and what was the other one? Cardinal Health. So these ones right here are positions I can remove. I can equalize these positions. Let me go ahead and just select all, equalize, and save. And yeah, these are just going to be positions that I've removed from my portfolio already. They have zero equity in them. That would be 3M, Cardinal Health, Kimberly-Clark, Southern Company, and Walmart. And I'll just kind of remove those pies from my portfolio. And now they're no longer there. So everything else in my portfolio has equity invested into them. And those positions right there, looks like I do have one sell. That is because Walmart has $1.48 in it. So that'll get reinvested automatically tomorrow. Now, of the positions, what sort of activity have we recently had? Or I guess we can jump into the 1 month really quick, because that's the majority of the media out there, and like friends, other investors that I've been kind of listening to have been talking about how January was a huge month on the decline. We can see that this portfolio is down roughly 3.97% over the 1 month. You can see here that in January 7th, I did add into the portfolio. I don't think this is even near bottoms, right? The market had been kind of turning. But if we look at the SPY here, SPY stock, in the 1 month, the market really didn't kind of fall up until like this period here. The 21st through the 27th was like the optimal time to buy, say, the S&P 500 or anything like that. And here I was buying at the 7th of January. So it's always hard for people to buy. They see a dip, they're waiting. Will it fall? Will it fall further? Will I buy? I didn't wait to see if it was going to fall further. I just looked at my portfolio. I made the decision on what companies I wanted to buy more of for the long term, and I added equity. There was a bit of a bounce right here early on between the 10th and the 12th, but then the market lost steam after the Fed announcement that they were going to accelerate and raise rates a little bit sooner versus later, and potentially rise, even 0.25% to 0.5% there, and the market just kind of lost it after that. So there we are on the 1 month there. And then if we look at the last week, this has actually done a lot better. I think today has helped out a lot. Today, okay, so essentially today, on a good day, right, the market did excellent today. If we look at the research tab here, the S&P was up 0.74, the Dow Jones up 0.8, the NASDAQ up 0.7. My portfolio not up a whole lot today, but again, I'm not down for the month a whole lot either, versus say the other indexes. If I look at the 1 month here, I know we'd already kind of seen this here, but the 1 month there on these positions, yeah, my portfolio sits more along between the performance of like the Dow Jones and the S&P 500, just because of the collection of dividend stocks that I have within the portfolio. So yeah, that we've looked at we've looked at the 1 month, we've looked at the week and the day here. As far as the activity goes, so I did make 5 sells back on December 27th, and we already discussed these. I sold a little over $1,200 of 3M, $1,100 of Walmart, $1,000 of Cardinal Health, Kimberly-Clark. There was $1,500 right there, and Southern Company $680. These positions right here were positions that fundamentally haven't done anything over the last 5 years of me owning them. I looked at their earnings, I looked at their performance, and I said, you know what? I want to thin out my portfolio. I think I had 39 some holdings at my high in my portfolio, and I really just want to thin it out. So here are the positions right here that I had sold out of: 3M, Cardinal Health, Kimberly-Clark, Southern Company, and Walmart. And here we are looking at a 5-year chart. So this is, hard to see percentage-wise on here, but I can go down here and change it to percentage-wise. And Walmart has been the best performer here. Over the last 5 years, Walmart has skyrocketed up to 112% return. But that's not the same for a lot of these. Utilities generally increase, year over year. Again, we talked about the rate of increase on utilities. It is utilities average about 5%. They increase your bill by 5% per year. That all goes to the bottom line. 5 by 5 is 25. So, Southern Company did a little bit better overall. They're up 40% over the last 5 years. But here we are with Kimberly-Clark up a measly 13%. 3M even worse, down 4.42%. And Cardinal Health down 31.88%. So I sold a lot of these already in the green. I was positive from when I had bought them back around 2019, anywhere from 2018 to 2019 was when I had purchased a good majority of these positions. I can probably actually go back and change this to, I think, 2018. So I think if I look at my portfolio here on M1, and I can see here, I started this portfolio back on January 8th of 2018. So I can actually just go in here and punch in January 8th of 2018, and I can see what the performance is of these. Now, I didn't buy 3M at way back when. I bought it here probably in 2019, 2020. I remember selling it, and I eventually broke even on, a bunch of these positions. But they're just not positions I wanted to hold for the long term. When I looked over their net income, free cash flow, revenue, their earnings per share over the last few quarters, what's expected of them for the future, I didn't see the potential there. So I just removed them from the portfolio. Now, jumping back over the M1 Finance and taking a look at the activity, in between selling out of these, I gave it a little bit of time. I wanted to digest my sells. I wanted to reevaluate my portfolio, take a look at my positions inside of the account, which ones I wanted to double down on and move that equity into. That was $5,656 that I had completely sold out of. I didn't want it just sitting there on the sidelines. The market here in January started to tip. I wanted to get that push back into the market as soon as I could into companies that I believed had the potential for growth in the future. So 8 buys, I bought into Apple. Again, I put $1,000 into Apple. Pfizer, I put $667. Lowe's, another $1,000. Realty Income, $500. Avery Dennison, another $500. Essex Property Trust, $500. WP Carey, $500. And Digital Realty Trust, $1,000. So Digital Realty Trust, this one's been beat down the most out of the positions that I bought here recently. I have another tab for these ones up as well. So these positions here are the ones that I purchased with the equity that I had sold out of. So I purchased these on January 10th of 2022. And here we are. We have January 10th, 2022 as my date range starting. And a lot of these companies, every single one of these companies I think is down besides Apple over the time frame that I bought them. But when I look at the market's down still. So I'm not scared or worried at all. I think these are great positions over the long term. So Apple, since I purchased Apple, I doubled down on that $1,000 right there. It's up 1.41, and that's the only positive one. And that's actually pretty good with the market having fell 10%. You know, that time frame here, I bought right here. The market had fell an additional 7.48% itself. So I'm not expecting a quick recovery on most of these, but I did. Again, I put $1,000 in a digital realty trust and the remaining other ones out there. But over the long term, I feel like these have really good opportunity here. Realty income, I've just bought that one just because I like real estate. I haven't been purchasing as much real estate as I would like, physical real estate. So I'm using digital realty trust to buy another real estate investment asset, a REIT. Without going out there in the market and just kind of buying a REIT. WP Carey's the same way. That's a REIT. Essex Property Trust is a REIT. Realty Income is a REIT. So right there alone, half of my buys that I bought, 4 of them were REITs. The other ones, Apple, that's, you know, tech. Apple's gigantic right now. Pfizer, Lowe's, those are all, you know, those 3 companies right there are very nice. Avery Dennison, pretty nice. Probably not well as known throughout all the other ones, but all of these I feel like have much more growth potential. If we look at the earnings, I don't know if I can bring in earnings for all of them. Let me see. Okay, yeah, the only one here that's showing negative earnings per share growth over the last 5 years is Essex Property Trust, and that's fine. That's one that's based off FFO, funds from operation. That's a REIT. So, you know, no issue with Essex Property Trust having earnings per share on the negative trend there over the last 5 years. But those are the companies that I had purchased. And I don't want to dive too much more into these companies. What I want to do is kind of go over with you guys the companies that I am holding. It's been a while since I actually made a video. It's been a whole month since I made a video. And we're still in a bit of a dip right now, say 4 or 5%, right? So what I'm going to do instead is, again, I have another tab right here where I've actually included every single holding that I'm currently holding here. And we're going to be looking at 5 things right now. We're going to be looking at the current price. We're going to be looking at the current yield. We're going to be looking at the 200-day moving average and the 50-day moving average. Those are the only 3 metrics that I'm looking at right now, because these are positions that are already in my portfolio. I've already chosen to buy them based on other financial metrics, you know, such as their earnings per share, their revenue, their net income, their balance, their debt, you know, their assets, liabilities. I've already gone through these and kind of screened them in the past and bought into them for the long term. So I'm not going over any of that information. All I'm looking at here is opportunity in the current market to kind of average down or buy more of, right? I have only $86 in the balance, but starting on Friday, I'm going to go ahead and kickstart my schedule once again of adding money into the portfolio every Friday in order to max out the Roth IRA for the year for 2022. So really quickly, let's go ahead and cover the companies here. Apple right here, it had broke below that 50-day moving average, didn't stay down there very long. That would have been a really good opportunity to buy, but you can see here it hit about 150 some change, like 158, maybe even 160. Did a quick bounce and is now trading at 174 and 61 cents. I think it will, you know, hard to know what will happen here in the short term. Again, with rates rising, the Fed potentially announcing, you know, they're going to be raising rates here in March and potentially announcing additional rate raises throughout 2021, 2022, 2023. We could see these tech companies fall. Anytime Apple falls, say below that 50-day moving average, you can see it doesn't often drop below the 200-day moving average. So trying to wait for a company like Apple to fall below that 50-day moving average, that 200-day moving average, is just not something to kind of wait for. But if you can see Apple trailing below that 50-day moving average, that could be a really good opportunity to buy. And right now, I already loaded up on Apple back on the 8th of January. You know, during the initial dip right there, I didn't buy in at this get the you know the gorge, but that's okay. Avi here. Avi's been blasting off for quite a while. I did even get phased here in January. There was a little bit of a rockiness, right? But really, not much of a phase. It's trading again near back at all-time highs. It used to offer a 5 or 6% starting yield. Avi current starting yield is at 3.88. I feel like this one has opportunity there long term, but I feel like it's really, really expensive for that opportunity. ABM Industries, this is one that's been kind of on the downtrend. I have to kind of write this one down. Let me go ahead and do that real quick. I'd like to take a look at why is ABM down so much right now. So I'm going to make a list here on my side because this is the first time I'm kind of reviewing these as well. So right now, ABM Industries has been ticking down since looks like May of 21. So why have they been ticking down? I'll have to look at their earnings. I'll go through a couple of their earnings report in the past and take a look at, you know, what is affecting this company. But they've been kind of flip-flopping here. They had a death cross here, 50-day crossover the 200-day. That's a downwards, you know, trend right there. There's really nothing breaking them back up right now. Looks like they hit like a bottom a little bit below 40, bounced. They're at 42, so if they can sustain this $42 mark, you know, $42 mark for quite a while, and trend up from here, we may see that golden cross up here as the 50-day crosses over the 200-day moving average once again, and that would be a potential for buy. But again, this is a long-term position, so this could be an opportunity right now to buy if it looks like it's stabilizing at this $42 mark. So I wrote that one down on my side. Avery Dennison, here we are. This one has been trending sideways since, again, May of 2021. Really hasn't done a whole lot. It is offering a 1.29% starting yield. The current price is trading below 50-day, 200-day moving average. I'm not sure. I think I bought a bit more of this one, right? That was one that I had bought. Avery, yeah, right there. I purchased a bit more Avery Dennison early on in the dip, not at the optimal dip, but we'll kind of see how this one kind of plays out. Colgate, never really broke below its 50-day or 200-day here during January. It looks like it stayed pretty much above it. It did trend lower. It looks like it's probably bouncing off its 50-day moving average. We did see a golden cross right here. So we saw that 50-day cross over the 200-day. We already saw that rising. You know, it rose from $75 to now $81. Colgate is one in my portfolio. If this kind of bottoms out and bounces off that 50-day moving average, this could be a really good opportunity to add a little bit more to Colgate. So I think Colgate looks like a strong, you know, strong-ish buying opportunity. But again, you know, here in the last, 2 years, 2.5 years, 2 years, 1 year, looks like 1 year, it really hasn't done anything. So buying it here towards these highs of $84, and then it dropping back down and retesting the $74, $75 is kind of like what the range. So again, I'm not going to actually write that one down. I'm going to wait and see how this one plays out. Clorox, this one's been downtrending for quite a while. We can see that 50-day moving average right there. Looks like it was going to break above the 200-day moving average, but lost momentum here in January just because of the market overall falling. So yeah, just kind of holding off on that one to seeing how this one kind of plays out in the future. Cisco did drop below its 50-day, 200-day moving average really, really quickly. Now, this is the 3-year timeline right here. So I know in the past that I had sold Cisco, I think like $60. I remember I sold a good chunk of it and then I rebought it. So I would have to look at the time frame for Cisco. So I go in here and take a look at Cisco. I remember I did. Yeah, I bought and then I sold. Okay, I thought I had sold a lot more of it. I guess I really didn't. So yeah, Cisco right there, $55.37. I'm not sure. That one could be a little bit of a buy, but I have to look at that one a bit more as well. Digital Realty Trust, I did buy this one back on January 7th. And let's look at the 1 month here. Yeah, so I bought it right here around January 7th. I loaded up $1,000 and it's been downtrending here at now 147.74. So it broke below its 50-day, 200-day moving average. I'm not planning on buying any more of Digital Realty Trust here for the moment. I'm just going to hold off on buying it. It is offering a 3.14% starting yield. I think it is one of the nicer REITs, but it is a risky one because it is within the they rent out tech space, like what's it called? Like, I know we use a DR site for ours, like a redundant site. So they allow companies to rent out storage for these like tech cabinets and such. So it's kind of an interesting company right there. Could be kind of beat up here in the short term. Okay, so we're looking at Essex Property Trust right now. Off its highs, it did drop below its 50-day moving average, bounced off the 200-day moving average, is now kind of making its way back. This could be an opportunity to kind of look at Essex. I do like Essex. This is a multifamily REIT. So they invest in multifamily homes, apartments, multifamily homes. And this one has been doing excellent over the past 5 years or so. You can see here 2020, bit of a dip right there. But besides that, every company fell in 2020, but it has had a very nice, strong recovery here throughout 2021 and going into 2022. Hormel Foods right here. This one's kind of tricky. I had bought Hormel Foods, I think right around this period right here. I'm not adding any more into Hormel Foods. I think I kind of bought it as a short-term play. I have to go back and look at my notes that I wrote here, but I didn't buy it as a long-term play, right? I did start buying it back in June 21, and so if we look at June 21, that would have been right around in this time frame here, and then I started averaging into it throughout the year here. So here I started buying in June, I bought a little bit more in July, August, October, November. So I slowly added to this position during this downturn, and here we are. It has recovered, not really crazy off the highs here. It's at $47, $48. So I may end up taking profits on this one and kind of moving it into something else on Hormel Foods. So take profits potentially. And, I'm always looking for opportunities to kind of thin down my portfolio and move equity into my longer, higher growth potential companies. And Hormel Foods isn't one that I see really turning around and like diving into specific aspects that are groundbreaking. It's a large company. They're not going to be like the Beyond Meats or Tattooed Chef or what's the other one? Impossible Burger or something like that. Forgot the brand, Impossible brand or something. They don't have, with their size, right? It's going to be hard for them to really turn their company around and really get it moving in any one direction. So I think Hormel Foods could be on just kind of like the chop block, just kind of knock it out of the portfolio, move the funds elsewhere. IIPR, Innovative Properties. This is another REIT right here. This one, this one took a nosedive here, starting in 2021, continuing here in 2022. It looks like it is doing a little bit of a bounce here at 198, but it straight broke through the 50-day and 200-day moving average very quickly. This is one I want to look at further. Keep an eye on. Because this could do a lot more damage, right? This one could continue to keep falling pretty easy. There's really no stopping it till about 160. This could just kind of chug down all the way down to 160, retest, this sort of like support level before it kind of decides, hey, do I want to fall back down into the 120s or do I want to continue from there? So I have to look over the earnings and such. Johnson & Johnson, just great company overall. This one really doesn't have a whole lot of dips, so you can kind of look at the 1 year here. Prices in purple. Here we have that double bottom. It fell below 200-day, 50-day moving average. The 50-day crossover to 200-day didn't stay weak though. It quickly bounced back We can see 50-day and the 200-day are kind of crossing over once again, showing some support. J&J is always a really good one to potentially buy more of. If it's in your portfolio, you're seeing opportunities here for the long term. JP Morgan right here with rising rates. This is going to be beneficial for JP Morgan. Here in the short term, January, we can see a very nice dive for JPM, diving from nearly $170 at highs to now 151. So for sure, I think if I were to buy one right off the bat, without looking at anything else for the long term, JP Morgan would be one. It's $20 and some change off, nearly $20 off their highs. With these rising rates, I think that JP Morgan is in a really good position to benefit from the upcoming environment here. So yeah, pretty good right there. Lockheed Martin here. Yeah, that had a straight crazy growth recovery. I know I'd bought a little bit more Lockheed Martin. I think down in the 340s, 350s was the last time I had bought a bit of Lockheed Martin. I am not going to be buying any more Lockheed Martin for a bit here. We can see here, yeah, we only bought a little bit back in November, August. We started loading up on this one, August and November. So if you look at August, September, August right here, and November timeframe, probably right around here, right? Wait, September is the 9th month. So it would have been in this time frame. And then November would have been in this time frame. So how much did we buy of Lockheed? So we did the majority of our buys in August, and then we bought a little bit more in November. Okay, yeah, so still, did buy a little bit of that dip, especially in November, bought a nice bottom-ish dip right there, and it's fully recovered back near highs. So I'm going to let, Lockheed Martin kind of chill, not buy any more of that one at the moment, but really nice to kind of take a look at that whenever we can. Lowe's did dip below its 50-day moving average. It doesn't dip below 50-day moving average very often. We can see a double bottom on Lowe's right here. So if I was looking to add a bit more, Lowe's would be another good opportunity to buy. And that was when I did buy more of right here. I think I added like $1,000 or $500 here of Lowe's. You look at let me go ahead and remove this, go back to my buys. Lowe's, I added $1,000 into Lowe's. Yeah, so I found that like Lowe's at this opportunity that it had fallen a bit, and I just kind of added a bit more of. So I'm not going to be adding any more into Lowe's, but this could be a really good opportunity long term to kind of buy a chunk of it. Lowe's and Home Depot, those are really your only home goods stores that you really go to because you can physically see what you're buying. I feel more comfortable buying hardware, my lumber, like anything around the house, I go to Lowe's for. I don't order it online, so I think they have a really good niche of people that go into their stores and buy it to see it and test it out, have somewhere local that they can return and ask questions versus buying any of those things you'd normally buy at Lowe's online. Main Street Capital, I did buy a bit more of this one as well back in January 7th. It did break below 50-day, 200-day. Looks like it's kind of creeping back over that 50-day moving average. Method Electronics, this one's breaking down below 50-day, 200-day moving average. I'm going to let this one settle. This one's one of my riskier, smaller cap companies, so I'm not going to be adding any more into that one. Merck is an interesting one there. It is trading at $81.92. It looks like it did get a little hammered here in January, but quickly recovered, if not fully recovered where it had been at in January. It's not near its highs of $90, but I think that $90 mark was super overvalued. I forgot what caused it to go up there. I don't remember if that was earnings, but it did a huge drop from 90 all the way down into the low 70s before it actually hit that bottoming out support and then kind of recovered. So this could be a good time to either take profits if you think that $81, probably look at this one. Let me go ahead and write it down to take a look at the earnings, or just stick with it long term, right? Maybe just not do anything with it, just let it sit, which is probably what I'll end up doing. Realty Income, that I already saw that one. Oh, that was Main Street Capital. Yeah, I'm not going to do anything with these ones. I like letting those ones ride out. Pfizer did fall below its 50-day moving average. I think I bought a bit more of Pfizer as well. Yeah, Pfizer, I added a little bit of that into Pfizer here in early on January dip. So I'm going to let that one kind of settle as well. And selective insurance, I think this one will do well with rising rates. It didn't really get hammered here after the Fed announcement. There's always that wiggle room just because of volatility and the unknown. So it's been kind of wiggling in this range since September 21. So kind of interesting. I'll have to look at this one as well to see why it's been in that wiggling phase. Siggy, yep, good old little Siggy right there. It's a small market cap company, I think, as well. Stanley Black & Decker, this one took a nosedive here in the short term. It has been on a downwards movement since May 21. So there was a couple other companies here since May. I think there was ABM, Avery, that had been on a downwards movement since May of 2021. So a lot of these companies have all sort of had the same growth. So ABM and Avery, oh, that looks horrible. I'm not going to do that. But yeah, it is trading below 50-day, 200-day moving average. There was a period here where Stanley Black & Decker had been at $220. So that is pretty insane to see it having dropped so fast just within the last 6 months. So that is one I would want to take a look at. Why is it dropping so much? Why is it having such a hard time getting going? It's been in this range of 193, 176. And it does this 176 right here, 193, doesn't quite make it, falls a little bit, about half, recovers to 193, falls back down to 170, up to 193, and down. So it's sort of like in this path. So I wouldn't sell it at this time. This could actually be one I could potentially start buying a bit more of in this 170 range, and just kind of averaging into it. So that's Stanley Black & Decker. Cisco Corp, we can see this one trading above 50-day, 200-day moving average. Take a look at the 3-year here. So yeah, just a slow, steady grower. This one had issues with supply chains as far as restaurants and businesses shutting down. They generally supply those businesses and restaurants that had shut down. So Cisco Corp has been sort of trending sideways on the price, and that is pretty good in the environment that we have been in for the past 2 years. So see the company have recovered out of that dip in 2020 back to where they had been at, and then kind of trending sideways in this current state is actually fairly good. So I think that one itself is pretty nice as well. UGI Corp, this is the utilities. I know I'd sold out of my SO. That was my other utilities as well. I don't plan on doing anything with this one. It is trading above 50-day, 200-day moving average. Doesn't look to be offering any sort of a discount here in the short term, but if you're buying it for the long term, it could potentially offer a bit of a discount. It hasn't recovered off its 2020 highs. We can see that back in, I don't know if I can see stock splits here. There may have been a stock split or something. Otherwise, there's been a huge decline throughout 2019 into 2020, and then it's been sort of like in the recovering phase. I'd have to see when I started buying this one up. Let's go look at UGI. And I started buying this one in December 2019. So yeah, here's 2019. Here's when I started buying it. And I started buying, just $37. And then March, I added a bit more. And just kind of starting to, I bought it quite a bit here in 2020. So yeah, 2020, I added to UGI Corporation. I'm positive in that position. So it's just been one that I bought during this little downtrend right here. I think its earnings and other financial metrics checked out, and it's just been slowly recovering. It's just kind of in the portfolio. I have a really good buy price on it. Let's see, what is it? What's my initial buy-in at 44? Is that? Yeah, I didn't make any money there, but that was in December timeframe. So let's go look in the, where's a good chunk? I really probably don't have a lot of equity in that one. 46. That's even worse than where it's at. 25. What is up with that one? So yeah, there was a time when UGI fell to $25. So yeah, that's pretty crazy. Here in this time frame, yeah, I can see right here, $20 right there. So I must have bought like here in this time frame at $25. And that's why you dollar cost average. You don't know when the bottom's at, and a lot of these companies you just kind of buy in a little bit, buy in a little bit, buy in a little bit, and just over time it averages, and you end up net positive buying in on these little dips. And then WB Carry here, real estate investment trust right here. I like to hold this one regardless of kind of where it goes. It pays out a nice yield. It had been having some crazy growth here in 2019. Then it just fell off a cliff. 2020 did it like a rock, fell all the way down to the low 40s, recovered halfway, and it's been on a slow recovery since then. Here in January, in the 1 month, we can see that it did take a bit of a dip. It's been kind of down. I think this is one I kind of loaded up on as well. So here on the 7th of January, I bought a bit more. It is down, some percentage there off. But WP Carry is definitely one to kind of, I like holding it for the long term. No biggie on that one either. I think I started buying it as well. I'm not sure on the price on the date. I think I've held this one since the beginning. So yeah, my first buy of WP Carry was back on October 20. No, I have another page here. Look at that. Yeah, so this is one of those ones I bought initially. This has been in my portfolio from day zero. $385 is how much I initially started it with. And then I just been kind of averaging into it throughout the years. And here we are in 2022, right? And that one is up 64% over the last 4 years. That's pretty good growth right there. Plus, dividends reinvested into it, so it works out fairly nice. So yeah, we took a look at all the positions within the portfolio. I think the ones that stand out the most were JP Morgan right now with rising rates in the current the current area that it's at. So if I look at JP Morgan here, it's up 58.21% in the current time. But I feel like this one right now offers a pretty good dip. It's obviously going to rise. It's going to raise my cost basis, my average share price here. It is priced at 151. I don't see it coming back down to 113.34. It is still trading, not. This is the 1 month right here. Yeah, they're not trading near. What was it here? Let me go look at JP Morgan again. JP Morgan. And they're at 151. Yeah, I think their high was like 170. And I don't remember saying anything negative. Like, JP Morgan's a good company. I bank with Chase. So I've been with Chase since, I had banked with WAMU, Washington Mutual, back in like 4th grade or 5th grade. And then Chase bought them out. And then I just been with Chase the entire time. So I don't see any issues with their banking. I've never had any issues. I think I have my personal account with Chase. I have 2 business accounts with Chase, and I've never had any issues with either one of their their products or their services that I've used from them. So yeah, I don't see any issues buying a bit more of Chase, even at this price right now. So what I'm going to do is just kind of put in, I don't have a whole lot right now, but I'll have more on Friday as I restart my scheduled task here. And I can do this by going into transfers. I can go into my rules. I can go into my Roth IRA, and I can re-enable my schedule, because last time that I had added anything into the account was back on December 3rd, 2021. So I'm going to go ahead and re-enable that schedule. How many weeks do we have remaining? Weeks remaining in 2022. We have 47 weeks remaining in 2022. So that means we're going to take $6,000, divide that by 47 weeks. I'm going to add $127, and we'll say $127.66. $127.66 right here. So we're going to go ahead and we'll hit done, but I need to adjust this. how do I adjust this here? So do I have to go in here and disable again? Oh no, I have to edit. And I go in here and type in, not 127, it was, what was my calculator at here? Okay, 127.66. Oh yeah, about 66. There we go, on a Friday. And yeah, I need to re-enable that. Hit done, and there we go. Every Friday, I'm going to add $127.66 over the next 47 weeks, and that'll max out the Roth IRA for 2022. So there we go. We went ahead and kickstarted it. This money will get invested tomorrow. We already saw futures here are positive. Yeah, we're already positive for the futures right here. If I refresh the page, futures came down slightly, but still, the NASDAQ is up 1.22%, and that's probably based off, Google's move there in the after hours. So there's probably other companies out there that have moved positive really nicely that are just not shown here in the, what's moving after hours. There's a bunch more that actually had moved, but that is going to be it from me. What do you guys think? What are you guys buying out there right now as far as companies that you are buying and investing into? I would be interested in knowing what everyone is kind of going out there and taking a look at in these current markets. I had bought 300 shares of SPY last week at, I think, like $4.49. And I turned around and sold 3 call options for $3.54. SPY has already crossed over $3.54. So if on Friday they end up closing above $3.54, I will be forced to sell my 300 shares of the S&P 500. I think I've collected probably $2,000 in capital gains. That kind of sucks, but it's okay. And then I also collected a couple $100s of premium. So the total trade there within like the week is pretty positive. I still do not think that the S&P, the market itself, is kind of stable. I still think we have more room to retest that 10% correction, if not go even lower than that in the short term. But I'm not going to sell anything in here. This is money that I'm not moving anything out of. There's a bunch of accounts that I don't touch. I don't touch the Roth IRAs. I don't touch my Roth 401ks. The only account that I really move money in and out of the market is within my Merrill Edge taxable account. I have a taxable account where I just kind of buy the S&P 500. I do call options, I do put options. Because of the current time frame of the market right now, I don't know how much more upside potential we have versus downside potential with the current environment that we're in. So I'm just kind of taking advantage of the volatility, making a little bit of profits here and there, and just kind of going along with the market itself. So yeah, that is going to be it from me in this video. If you guys have any questions for me, go ahead and drop the questions down in the comment section below. Really appreciate everyone hanging out with me. Hopefully the video wasn't too long. I can see down on there on the bottom, it's at 53 minutes. So I think I will probably have to break these videos up in the future and kind of go over one topic at a time versus multiple topics in a single video. And let me know what you guys are interested in kind of hearing about, listening to, and discussing here on the channel. And I will see you guys in the next video. If you guys have not yet subscribed, go down below, hit the red button to subscribe, make it gray, hit the bell to be notified every time we release a brand new video. And of course, give this video a thumbs up, make it blue. And I will see you guys in the next video. Bye-bye.